Oh my gosh. All right. Sorry I'm late, man. Sorry I didn't click send.
You have to apologize to the listeners.
Well, I was going to apologize, but then I saw where your first chart was, so you can go fly a kite.
No, my first chart is not about Walgreens.
Look, man,
It's about the far right side of the chart.
I'm not, look, don't.
God, hot mic. All right, we have. So, listener, we usually spend about what 6 to 7 minutes preparing to record this thing. Today, we're going to spend 6 to 7 seconds preparing to record this thing. Record time.
Shall be interesting. Marcos is in a mood. Let's
I'm not in a
cue up the
mood.
band.
I'm in a mood. You're the one who did this, Walgreens. Brownie. Intro
It's
music.
a fact. Like, I'm not pointing out something that it's like you have to be hard to find. It's the worst performing stock. Worst.
I get it, buddy. You just wait.
We're going
You
to
just
talk
wait,
about the
dude.
right side of the chart. Or in this case, I'm not sure which is the right for you, but the
Man.
other side. If I go like this, it's the right side still.
Yeah, I'm gonna be honest with you. Why is this happening to Walgreens? What gives?
I'll talk about it. Don't worry. I got you.
Oh, thank God, because I was there this weekend picking up prescriptions for my children.
I was there too this weekend getting a COVID shot, and they got zero money from me. So unfortunately, that's not going to help your Walgreens stock. And pretty soon they're going to give out, oh, what do they say? The COVID tests for free too.
Oh, that's
Giving a lot
awesome.
of things for
That's great
free
for
when
earnings.
they're not making any money.
Yeah, if their revenues were equal to the length of their receipts, oh my God, it'd be
Or to the
so.
line in the Brickell store. Psh, that store does well. It must be like that Hillstone and Coral Gables that's like number one in the country.
No, no. In all honesty, though, if they just made their receipts half the size, they'd save so much in costs.
But sometimes there's coupons on the end of it.
Yeah, exactly. So you waste all this paper to then give people discounts? Oh my gosh, talk about double whammy.
Well, maybe you should work for them if you have all these ideas.
No, no, and give up this?
You're gonna have a job in 2 years.
No. No, look, it's gonna be fine. Okay, it's gonna be fine.
Welcome, welcome, welcome. Hear ye, hear ye. Episode 61, Talk Your Chart, 9/24/24. Marco Segura, number one, with number two, Brett Horowitz. We're going to start with a chart that I know is going to make you sad, but we're not going to talk about why it's going to make you sad for that much. Walgreens, unfortunately, is the worst stock of the entire S&P 500, which was your pick for the dogs of the Jow come January. I don't know how you made that happen, but that's hard to do, picking the worst. Um, Apparently, they're being sued by some people, so you can't sue them, Marcos, just because they're down. Okay, that's not a thing. Okay, you got to have some real reasons why you want to sue them. But add to that, I guess prescription drugs are killing them that you can get online. Amazon's eating them for lunch. All bad things. But we're not talking about that. We're not talking about the fact that they're down 64. Coke is up 24. My pick. We're not going to talk about that.
Thank you for not talking about it.
We're not going to talk about them being on the left and Coke being on the right. We're not going to talk about
Yeah.
that.
Hey, you're
Yeah.
you're a gracious winner. Like everyone, our listener now knows how gracious of a winner you are.
We're going to talk about the right side of the chart, not the left side where Walgreens is, the right side. Again, Walgreens, your pick left side. So the right side of the chart, interestingly enough, what's on the right side? Lots of dots here. You can't tell all the dots are. Utilities, number one sector for 2024. What's been in the news recently? Constellation Energy took over 3 Mile Island in Pennsylvania, cranking out energy for Microsoft, who needs energy for AI call centers. Constellation is up 120% in 2024. Not even the best stock in there. It's Vistra Corp, which I've never heard of. Also, utility up 182% for the year. So I think all we've heard all year long is that, technology is the place to be. Technology is crushing it. But there's this boring, sector called utilities doing really well. Constellation, I wasn't realizing this. They now supply the 1/5 of the US's nuclear power. It's a pretty big amount. There's like 60 stations all around the US, power plants. And so sometimes, the story is one thing, but in reality, you wake up and look and say, wow, who knew that this was going to do so well this year?
Yeah, the ones you never expect. I thought you were talking about Constellation Brands, which is a beverage company. You're not. You're talking about Constellation Energy, which I have also never heard of. Okay, I'm going to torpedo your next chart and I'm going to throw my chart in because it's perfect for what you were just talking about, which is percentage of the S&P 500 stocks that are outperforming is on pace for the best performance since 2002. So basically, all the concentration and no one participating in the ups and ups of the market has turned around entirely this last quarter, where you see that 358 or so of the names are outperforming the index, which is an example of breadth, BH. And I think that's a good thing. Would you agree?
Yeah, for sure. At first, I was confused by the percentage being 350% until I realized that this was the number of stocks beating, not the percentage. It's a little misleading chart. Seems to
No, it's not
test.
misleading. If you look at it, there's zero signal to percentage. It's just a number, and it's referencing out of 500, but it's fine. Together we
The,
figured it out.
the chart says percentage of stocks outperforming, and yet it's 350. But okay, I get your point.
Yeah,
Yes, it
no,
is
you're
a good
totally
sign.
correct. Yeah, you're right. It is a slightly misleading, but thankfully we're here to guide our viewer and to let them know that it's the number, not the percentage.
We have had lots of conversations in past TYC episodes about how the top seven are crushing it and they're the reason the market's doing so well and yada, yada, yada. And, the NASDAQ's fallen off a little bit in the last few months. It was killing it. And now it's, I think, right in line with sort of the S&P 500. So you've seen, like you said, more stocks doing well over this period of time, which is a very good sign for sure. I think that is why the market is doing so well. September tends to be such a horrible month overall. It's the worst month statistically of the year, but not this September, because this September we are up.
Yep, Magnificent Seven, their share of the returns of the S&P 500 in 2023 was 63%, and right now it is 44%. So the S&P outside of the Magnificent Seven is responsible for 56% of the returns, as opposed to 37% last year. So there you go. That's what keeps bull markets going. So we shall see if it persists, but ultimately a good sign that we're getting a little bit of a turn and increased participation from other parts of the market that aren't just the big AI names.
Absolutely. And I think September was obviously helped out by the interest rate cuts that happened earlier this month. So we're going to talk about that in a little bit. So moving on
Yes.
to the next chart.
But wait,
So
hold on. What are you going your chart? Because I think my chart's more perfect for the next piece.
fine.
Ready? So I just threw it in here. And we're going to have to give a source on it because I didn't give it. So All Star Charts is a source of this chart. Mina, I promised to get it in there. So why did I throw this in there, BH? Just because breadth is a good sign in the market, right? Basically, that's just a fancy word for increased participation, specifically in this case, of the 500 companies that make up the S&P 500. A fair amount of folks, whether clients or friends or barbers, whoever it is, are asking, do you deploy more money now? We're in the middle of this bull market. Is it long in the tooth? I'd rather wait for a pullback, that whole thing. While we are 2 years into this bull market, right? October 12th of this year will be 2 years. Right now, that's 486 trading days, and we're up just shy of 60%. And what this chart is showing us, specifically in the green square or rectangle, depending how you measure those lines, is that the average median bull market sees growth that's a lot more than this. So it doesn't mean that it's going to continue, but it's just letting you know that history has shown that we're still in the early innings of what could be a very, very extended bull market. Increased breadth is helpful. And just because the Fed is cutting rates, although that usually can happen, I wouldn't say usually, but it can mean recession around the corner. It doesn't have to mean recession. And even if it does, not all recessions are made equal, meaning not everything is COVID and not everything is a great financial crisis. So I wanted to throw this in there, BH, because it shows us that, yeah, 60% up since October of 22 is great, but it could definitely get better.
Well, what the chart also shows is the right-hand side, which is the bear markets tend to be a lot shorter in period and not as severe. Although, right, a 30% decline means usually about a 50% recovery needs to happen to get back to 100%. So understand that those percentages are a little bit more meaningful when you're going down. But still, to your point, right, we see we've had, I think it was almost 40 all-time highs so far this year. I think we're right near on at least the Dow and an S&P an all-time level now as we're recording this episode. But it's not to say it can't continue because you could have said the same thing 39 all-time highs ago earlier in the year. Oh my gosh, we had an all-time high, it's going to fall. And then second and third and fourth, and it just keeps going up and up and up. And that's the what the market does. So it's not about, trying to get in at the bottom or trying to find a falling sword. That's hard to do. Just get in and enjoy the ride.
Yeah, I'll enjoy the ride with you. Go ahead. I'm not going to torpedo your next chart, I promise.
Okay, it's not about Walgreens. We're gonna change
Thank you.
topics a little bit.
So kind.
The stock that you picked down 64%. We're not talking about that. This is about interest rates. Okay. So the Fed just recently started cutting rates for the first time, down 0.5%, 50 basis points a few weeks ago. This first chart, which I'm showing here, is the 12-month inflation rate measured by the core PCE. PCE is their preferred inflation measure. You can see, as opposed to other situations over the last few decades, we started off at a higher rate than other times. It's coming down quite well. The Fed thinks it'll be down to 2.2% come next year, which is near their 2% target. But the rate cut happened a little bit. Some people are worried a little bit too late because we're at a higher inflation rate than normal. That's the good thing in terms of cutting the rates. But the bad thing is, oh my gosh, the economy is already starting to weaken a little bit. So which are we? Is cutting rates a good thing because it means that we're going to have cheaper borrowing? Is cutting rates a bad thing because we're already too late, and that means that we're going to have a recession coming? What do you think the Fed's seeing here?
Man, there's too many kind of storylines that you can make a good case for, as far as late or early or not. Look, if they were late, all they just said now was we should have cut 25 a month ago. We didn't. So we're going to kind of pretend like we did and just do 50 now. Um, it's interesting that the market, what happened at the 10-year after they cut 50? The 10-year did what? It went up. It's so funny. Why? Because not not only did he cut or they cut 50 basis points, but just as important is the signaling from Jerry Powell. And he basically said, we're doing 50, but don't get used to it and don't think we're doing this every single time. So the 10-year basically had to make an adjustment because the market was expecting more in the form of cuts over the next 12 months. So the 10-year actually went up a little bit, which just goes to show you that it appears that Jerry and company will continue to do what everyone's done since Greenspan, basically, and definitely Bernanke, which is they're going to let the market do a lot of the work for them by signaling, so that the market ends up being self-correcting.
His exact comment was, "We don't think we're behind, but I think you can take this as a sign of our commitment not to get behind." I mean, that he and the Fed have
Hold on,
been
hold on,
so,
hold on. Did you say behind 4 times there?
we don't think we're behind, but I think you can take this as a sign of our commitment and not to get behind.
I love that. Let's make it t-shirts.
But I mean, he's been very clear, and so is the Fed, that this was not a mark because they see a recession. They don't see weakness. I think the percentage of people seeing a recession is very, very small now. So how people could take this as a sign that, oh my gosh, he's cutting 50 basis points because a recession's happening, because the economy is weak, because the numbers are bad. No one's saying that. No one's seeing that. Yes, unemployment's up a little bit. Yes, manufacturing maybe is right near 50 above and below, which tells you whether, we're contracting or expanding. But by and large, people have a job and things are doing just fine. GDP's fine. Like there is
Yeah.
no,
So you just said it. Jobs is the big inflation recession indicator. The only issue is with the whole, ultimately the kind of terminal or existing value of unemployment is not going to be the big measure of recession or not. It's going to be the rate of change because you can get a recession even if unemployment is under 5%. So with the whole SAM rule, that's become pretty, or SAM, oh, you corrected me. I just corrected myself. The SAM rule, like that's gotten a lot of attention. That hit the marker that says, hey, we are in. It's not a signal of it's going to happen. It's a signal that we are currently in a recession. It hit when the rate of change of the 3-month average is 0.5% or greater. It hit. So are we in it? Are we not? Even Claudia Sam, the inventor of the whole rule, said that it's actually probably a noisier signal given what's happened since COVID. So who the heck knows? But if unemployment keeps getting worse, then we're going to get one because that's just how it works. However, to your point, everyone's saying, which again makes me kind of nervous when everyone's saying something.
yeah, but the SOM rule was just as accurate as, oh, flip to the next chart. You added a chart.
I did. I totally added a chart
But
because I
can
had
I
to.
I need to cover the next point, which is the SAHM rule also was the same rule when you had an inverted yield curve, which meant shorter term bonds paying more than longer term bonds. And as of a few weeks ago, that flipped. Now it's back again to being inverted slightly now. The 2 years paying less than paying more than the 10 year.
Yeah.
But as of a few weeks ago, the inverted yield curve was no more. And you can see here with all of the recession lines in this chart, every time that had been inverted pretty much over the last 40 years, you'd had a recession, but this time not. And so you have all these rules of thumb, but they don't work every single time.
No, they don't, but isn't it, and I can't totally tell from this chart, isn't it a lot of times that recession comes or is most felt after it uninverts?
Yeah, it could be. Yeah, it still could come.
Right?
You
Yeah,
don't know.
exactly. So, and again, then you talk about the magnitude piece. So why did again, I did a torpedo again. I threw a chart in here real quick because what's her first name? Well, anyways, Fed Governor Bowman, the first one to dissent in a vote. Michelle Bowman, she dissented, said, I want to do 25, not 50. It's the first time since like the early 2000s someone dissented. Good for you, freedom of choice. She dissented because she still thinks that the bigger risk is inflation and not employment. And I thought this chart was kind of interesting, and it's showing everyone is talking about reshoring, and this is all a function of COVID, basically saying supply chains were shown to be weak. We're going to nearshore and reshore a lot of these critical resources that we rely on. That by definition is inflationary. It's also good for corporate earnings, right? Because spending will turn into corporate earnings, but it does put upward pressure on inflation. So I don't know if that signals an inflation risk, but I do think it's fair to say that inflation should average a higher figure over the next 10 years than it did over the last 10 years. And I think we probably just need to be comfortable with that idea without thinking that hyperinflation is a real risk.
Yeah, the Fed has said that their sort of normal rate where they expect to get to is probably in the 3.5 range, 3.25, 3.5 range. I don't think anyone thinks we're going back into 1% and 2% ranges that we were for the last 15 years, where rates were super, super low. So I agree with you there. I mean, reshoring tends to be good if we're talking about critical components, but I worry that that allows companies to say like anything is going to be reshoring just because we want to have businesses make money here. We don't want to bring over, and we're going to tax. And I don't like all of that because there's things that are not critical that are still being thrown into that mix. Just
Yeah,
sort
I
of,
tend to, yeah, I agree. I think there is a little bit of a you throw too much money at things that are overly redundant. I'll probably just end up saying I trust the capitalists that run these companies to make reasonable choices in how they allocate investor capital. On average, on average, on average, on average, Brett Horowitz.
we need a Lena Khan to attack reshoring too, because what she's doing with
Lena
trust
Khan,
busting,
don't get me started on Lena Khan. We need a whole new episode. You have to leave too soon to talk about Lena Khan.
MVP. That's what I'm saying. We need more of her.
But
Okay,
what? I bet you want tariffs too. Jeez. Hold on. Are you done with your yield curve? Because I have one more chart for us.
let's finish it off.
Let's finish her off, man. So we just got the cut that we were talking about. So let's go to our friend Ryan Dietrich and see what the heck has happened in the markets over the next month, 3 months, 6 months, and 12 months after you get a cut at or around all-time highs. And you can roll through each of these rows here to see that you end up with an average next year return that is meaningfully positive. But as you might kind of expect, the average and the median over the next 3 months or next month is relatively muted because it just is. I guess I'd love to know, and it doesn't say it here, in which of these cases did we have a recession after? I don't know. Perhaps in the early 80s we did. And then I'm trying to see if there's anything around the early 2000s, but there isn't. So again, this just kind of gives you, all right, where are we right now? The Fed's cutting, market at all-time highs. What's the market done in the past? How strange, it's up.
This is dramatically optimistic for you because you were so pessimistic last episode. You must have woken up on the right side of the bed today.
I don't know, man. Maybe,
I
I don't know.
am all in, Marcos.
You are? So then I'm all out. Recession calls back on. Recession calls back on.
Okay. Well, have a good one, okay?
I'm gonna do my best. All I'm thinking about is Walgreens. I'm gonna go buy a prescription real quick, see if I can help them out.
Double down.
See you, BH.
See ya.